Good afternoon, everyone. This is Sam Agresti with ReadyWare. Today we're going to do a webinar on the famous PPP loan and really focus on the forgiveness piece of it. So I'm a director in the Columbus, Ohio office in the Business Solutions Group, and also part of the dealership practice group as well. Joining me today is Brian Denlinger.
Hey, I'm Brian Denlinger. I'm also with Sam here in the Columbus office and a manager in the Business Solutions Group, and I work side by side with Sam on our dealership clients as well.
Okay, Brian has been involved in a lot of the modeling and modeling this out over the last couple of months, and to provide some good insight for us today on the forgiveness side of this loan. So just kind of highlight what we're going to touch on today. Again, there's a lot of pieces to this PPP loan. I think everyone who's been involved with this program has been on the journey of the ups and downs and the changes from day to day. And so what we're going to focus on is really weight this webinar more on the forgiveness side, but we're going to kind of do a brief summary, a flyby on how we got to where we're at today on some things. So the points we're going to hit today, we're going to hit the timeline, kind of over a timeline, go over the provisions of the original act, provisions of the Flexibility Act that got passed last Friday, and kind of go over some key definitions of things you'll need in applying for forgiveness and you should be aware of already in this program, and also use of the proceeds and what's forgivable and allowable expenses. And then we're going to actually spend a lot of time going through the calculation of forgiveness. The SBA put out an application late May 15th, I think it was, and on the application, and so we're going to kind of walk through some of the calculations there, and then also going to wrap it up with documentation requirements for forgiveness R. So that's kind of the agenda for today. So with that, we'll go. So the overall timeline of the PPP loan was part of the Coronavirus Aid Relief Economic Security Act, known as the CARES Act. Now signed into law on March 27th. From there, and with the side there was what was known as a PPP loan, or the Paycheck Protection Program loan. And what that did was put an additional $349 billion aside to loan to small businesses through the banking system via the SBA. So they came through the banks, backed up by the SBA. And April 3rd, they started. April 3rd, there was some, was when they started the first round of applications for businesses. April 10th was when they started doing the self-employeds and the independent contractors. Also to note, in between all this was these interim final rules, which sounds kind of funny, interim final rules, but those were issued. There's a few of those issued through this whole timeline as well, and that was issued prior to the April 3rd opening of the application process. April 16th was really the first round of the PPP loan was 100% allocated at that point. Congress went back and added an extra $320 billion of PPP available on the 24th of April for funding to begin on the 27th. So between the 27th of April and June 5th, about another $200 billion of the second round funding has been claimed. There's still probably, last I heard, probably approximately about $100 billion still left in this program. Like I said earlier, about May 15th, the SBA on a Friday night decided to release the forgiveness application, and then last Friday, it seemed like Fridays, President Trump signed into the Flexibility Act into law, which was much needed. I think when this thing was first put out there, no one really knew the timing of the timing and effect of all these shelter and stay orders and when business would be able to reopen. So this law was really much needed to help fix some of those things. In between a lot of these interim final rules was a lot of FAQs. It was issued in between the rules, and so those were filtered out there. A couple of the more popular ones, if you remember, was FAQ 31 and 37, which kind of took this from a needs basis when you first apply, from an impact basis when you first apply to a needs basis. And then subsequently the FAQ 46, which kind of provided a safe harbor for the needs basis and kind of talked about how that process was going to work. And again, if you were if your loan was $2 million and under using the affiliation rules, you were deemed to satisfy the needs requirement. Also, for our dealers that are on the webinar as well, if you're a franchise dealer, they use the franchise identifier codes. Those affiliation rules were waived. So even if your loan, if your loan's under 2 million, but you've had a series of franchises, dealerships to use the franchise identifier codes for, those rules were waived as they were when you applied for a loan. So that's a good outcome for the dealers. One of the things there still isn't is if you got it really isn't answered is if you got an affiliated business, you own a franchise dealership, but you also got a body shop or a service shop that's outside that's not a franchise dealership, and how that would play into it. But that's something to be aware of. We haven't seen any guidance on how that would work. So kind of starting with the provisions for the CARE Act. This is the original act. Just want to kind of do a quick review of it, so, kind of build up to where we're going. It had an 8-week time frame to use the funds. It came out through interim rules, basically saying 75% of it had to be used for payroll expenses, allowing 25% for non-payroll costs. The amounts not forgiven was to be repaid over 2 years at a 1% interest rate. Now they also had two caveats in there, because this was really a payroll-driven program. Is that the forgiveness and reduction and the decrease in headcount? That was based on a 40-hour work week to determine FTEs. And also there's a forgiveness reduction if somebody's pay rate decreased by more than 25% from the base period. And we'll get more into those calculations later in the presentation. The CARES Act also, like I said, it talked about the full-time equivalent, the reduction in headcount. There was a couple of testing periods you were able to apply. One was and you used whatever base period worked better for you. There was one from February 15th, 2019 to 6/30/19, or you could use the first 2 months of the year, 1/1/2020 to 2/29/2020 as your base testing period. You basically talked about using a ratio of actual FTEs at 6/30/2020 compared to the lesser of the two above testing periods, and that's how you had to deal with the reduction of the full-time equivalent testing. Anything less than 100% ratio reduces the forgivable amount. So that's the mechanics of how the original act was in place. The second test was a 25% payroll reduction. And this dealt with if someone's pay rate got cut by more than 25%. And you use the analyzed rate, and we're going to go in more detail this later in the presentation as well. But you compared it to a salary and hourly rate tested at 6/30/2020 and to the base period. And if the reduction is greater than 25%, it reduces the forgivable amount again. So these are two provisions to kind of deal with the forgiveness piece of this, and we're going to get more into that as we get into the calculation. Jumping ahead, June 5th, the Payroll Protection Program Flexibility Act. There was a lot of talk along this. This was coming down the pike. We kind of waited to do this webinar based on, we kind of figured this. We've heard murmurs for about 3 to 4 weeks prior to this was coming down. The CARES Act was signed into law. Again, a lot of people did not know how long these shelter and stay acts were going to be in place. Originally, they thought maybe by April 30th, a lot of these things would be lifted and activity would be opened up more in May. I think as we got through it, they realized, especially in the hospitality and restaurant industry, these things had a slower turn-on period. And there's also a lot of other businesses that are still in the process of opening up as we do this webinar in various states. So this was a much-needed fix, I think, to give people the opportunity to use these funds like they were intended. These loans were not intended to be loans; they were intended to be grants. So I think this went a long way to fixing that. So again, this got signed into law Friday, June 5th. It amends the original act we just reviewed. So it basically expands the 8-week covered period into an optional 24-week period for some borrowers. Loans obtained after June 4th is required to use a 24-month period. However, loans prior, you have the option to still use that 8-week period or use a 24-week period. And that might take that might require some analysis to see which way works better for you, depending on your given situation. It also expanded some definitions on the eligible expenses, which we'll get to in a moment or so. And it also changed the allocation from the 75-25% for payroll, non-payroll costs. It went to a 60-40. Originally, the law had a cliff provisions in there that if you didn't hit the 60%, that you lost forgiveness of it. That, as of on Tuesday, got rectified and clarified that it is not a cliff caveat in there anymore. So there is partial forgiveness. The repayment period got expanded to 5 years. Those obtained prior to June 5th have the option to either use use the 8 or 24-week recovery period. After the 4th, they're required to use the 24 period. The ones that the non-forgivable amount becomes loans, like I was saying, becomes you have a minimum of 5 years, a maximum of 10-year period to repay the bank. It also talks in the Flexibility Act that you have 10 months. After 10 months to apply, at the end of the covered period, principal and interest payments will be due to the bank. So you have about 10 months to get that forgiveness submitted. And there's some safe harbors in there that we're going to touch on later. That was also part of the Flexibility Act regarding restoration calculation and things like that. Those dates have moved as well. So we'll touch those later in the presentation. Before we get to the forgiveness, I want to spend a couple of minutes just kind of going over some of the definitions. I think these are really important to have down. You hear a lot of terminology about the covered period. Originally, it was the 8-week period from the day you received your funds. And that final day of the covered period was 56 days into June. Well, it'd be an 8-week period basically when the funds received. So funds received on May 1st, considered May 1st your first day, and then June 25th would be your last day. Subsequently, they came out with an alternative payroll covered period. And again, this is only allowed for bi-weekly or more frequent payroll periods that allowed you to start the payroll, period, the first payroll after receiving funds. So, and that's for more frequent pay periods. And especially with our dealership folks online, there's a lot of different payroll periods and pay plans inside these dealerships, and this might be a more advantageous thing to look at if the alternative payroll covered period works. Again, it's an alternative payroll covered period. Does not apply to the non-payroll costs. That's still the 8 weeks starting with origination of the loan. Payroll cost. Again, this was a big thing that went on for weeks. Paid and ended up coming out decided it's paid or incurred. So it's cash basis in the beginning, accrual basis, and end of the period. And this is also the same for non-payroll costs as well. But so you get funded on a Thursday. You have payroll that comes out on a Friday. Checks are dispersed, ACHs. That period will count in the payroll period. Same thing on the back end of this thing. This back end it's accrual basis, so it's both. You get both the best worlds on this thing, and this is really advantageous. Full-time equivalent, they kind of identified as based on a 40-hour work week. There's 2 methods they give us to use on that. Option 1 was to calculate divide using a 40-hour week as a standard. So maximum would be a 1.0, and then you would divide the ratio into 40 to get the full-time equivalent. The alternative method was 40 hours would be 1.0, and everyone under 40 hours would 0.5. And this is a test you want to kind of walk through and do it both ways to see which way works better for you when determining the full-time equivalents, especially on the forgiveness piece of it. The base periods, the base period you're going to be comparing to, you want to do options 1 and 2 on that. And that one you prefer the minimum amount. On the back end of this thing, you're going to want to look for option 1 and 2, and you want the maximum number of FTEs. So you kind of want to work this both ways and do the homework and math on that. And we're doing that for a lot of clients right now, trying to figure out which way works best. Next, we want to talk about the use of proceeds. There was these allowable but not forgivable expenses. A lot of this got cleaned up, and that a little bit got cleaned up over the last couple of weeks, especially with the Flexibility Act. The payroll cost, obviously it's wages, tips, vacation, sick pay, employer paid healthcare benefits, employer provided health retirement benefits. That includes a 401k match, profit sharing contribution, as long as it was earned during the covered period. You do not want to double up employee deferrals in these as well, and either the healthcare benefit, either the employee healthcare benefits or the retirement benefits. It also allows in there state and local taxes, which in Ohio would be the state unemployment tax, pretty much. It also switched over to non-payroll costs. It allows the interest on mortgage payments for personal and real property. That was in place and obligations in place as of February 15th. It also adds in there lease payments on real and personal property. And this includes self-rental. They've never come out and just said self-rental was not appropriate. So again, make sure you have lease agreements and you're following lease agreements on this. And these agreements need to be in place prior to February 15th, 2020. Utility payments, water, electric, gas, transportation, telephone, internet. There's a lot to make sure that, again, on this side, the transportation, there's been a lot of speculation. There's an FAQ out earlier on self-employed people regarding gas. A lot of people have taken a position, and the gas for company-owned vehicles would be includable and forgivable based on the, and we haven't seen any guidance to the contrary yet. Other interest. This is basically what we understand, and we've the law basically is that in the forgiveness application, any secured debt, the interest is going to be forgiven. And this includes for our car dealers, folks on the webinar, floor plan interest. It does not include curtailments, and it also deals with vehicles that were floored prior to February 15th as well. So I think those dates are important. I think. And we concur, we saw some guys come up from NADA on the auto dealer side, and they could we kind of concur with their position on the floor plan interest as of right now. We're going to switch over now. I think that's kind of the basics of where we're at. I know we kind of went through a lot of things fairly fast, but that kind of gets you a summary of where we're at with this. Now we want to get into really the calculating the forgiveness piece, which is the main topic of this webinar. I'll turn it over to Brian.
Thanks, Sam. So as the name kind of indicates, the Paycheck Protection Program is meant to protect employees' payroll. Therefore, the payroll component is going to be the biggest part of the forgiveness calculation. The original 75%, 25%. The CARES Act, now 60/40, kind of helps out with that a little bit for those companies that have less payroll early on. But the expanded 24-week covered period should get most employers above that 60% threshold, if not closer to 100. So your payroll and your eligible expenses, getting that identified up front is going to be key. Ultimately, though, the payroll costs are going to drive the overall forgiveness calculation. So your goal should be to maximize your payroll costs and minimize any unwanted scrutinization of the non-payroll costs. As Sam mentioned, the self-rentals, although it's not specifically mentioned one way or the other, it's still sort of a gray area. Now, we believe that it's still allowed, but there could be some clarification down the road on something like that. So getting those payroll costs identified and potentially using as much of the loan as possible on those is really going to help out on the back end. The breakdown, as I mentioned, the 60/40 split is as Sam talked about, that cliff is no longer there. That was clarified just this past Tuesday. So if you end up using only 55% of your loan on payroll, that's still going to be allowed. You're still going to be covered, and you can just use less of the non-payroll cost. So that's still something that we can kind of look at ahead of time. It wasn't until the loan forgiveness application came out on May 15th where we kind of knew had any sort of indication of an ordering system on how this forgiveness application is going to work. Turns out that the 25% salary reduction test is the first component to any sort of reduction in loan forgiveness. So that test must be done first, and then we can look at the reduction in FTEs. So making sure that we identify any sort of reduction in salary and hourly pay on a per employee basis, because that's key. Looking at it on a per employee basis for that reduction. That's going to be the first real test that we have to pass, and then we can jump over into the reduction of FTEs. So starting with that 25% salary and hourly wage reduction, this does not apply to individuals who earn more in 2019 or earn over $100,000 in 2019. However, it's kind of a funny test. You could have a W-2 that shows less than 100,000, but in one specific pay period, if you annualize that amount, it could show over 100,000 on an annualized basis. So that's one thing that's going to throw some people for a loop, I think, is making sure we get that test correct. But it's in big picture terms, anybody that earned over 100,000 is excluded from this 25% reduction. Now, that's not to say that you're not allowed to give somebody a payroll reduction. If you're in hard times and you need to reduce pay a little bit, you can. So you're allowed up to a 25% payroll reduction without any negative impact towards your loan forgiveness. However, any percentage or any amount over that 25% reduction is going to come with consequences in the form of a reduction to your overall loan forgiveness. Now, your reduction, you have to kind of look at that, do some analysis, because if you're on an 8-week period, converting to a 24-week period, you're going to have a little bit more reduction over that 24-week period. So might have to look into that. The use of a 24-week period is just something to consider. You may be more beneficial to take less payroll over an 8-week period, but you'll have less of a loan reduction overall. So just something to look into, something to just kind of analyze a little bit. When it comes to the FTE reduction, as I mentioned, that is factored in after already taking into consideration the 25% payroll reduction. So the goal there, with how the testing is done during your base periods and during the cover period, your goal should be to minimize between option 1 and option 2, minimize the overall FTE during the base period. So that's taking those, using the 0.5 and 1 FTE consideration, minimizing that up front so that on the back end, you can have a higher ratio by maximizing your FTEs during your covered period. I'll go into a little bit of that later, so we can kind of see that with some examples. But for most companies, it's the most important factor in loan forgiveness is going to be maximizing this FTE ratio again. I think with most companies being able to use the 24-week period now, they should be able to hit their loan amount, but whether or not they reach their FTEs from before the testing period again, that's going to be the biggest consideration. So with the Flexibility Act being passed just this past Friday, the date was now changed from June 30th. Now you have up until December 31st, 2020 to calculate your FTE and make sure that you get that back to where it needs to be so that you don't have any reduction in payroll. Another thing that there was a lot of questions about is, if there's an inability to rehire employees. The safe harbor rules that have been announced are going to be kind of take care of some of those concerns, it sounds like. So the first real test, for safe harbor, to if you can't restore your FTEs, you have to look at the time period between February 15th and April 26th, 2020. If at any time during that period your FTEs are reduced below where they were on February 15th, as long as you return your FTEs back to those normal levels by December 31st, there's not going to be any reduction in your loan forgiveness, which some people had some concerns about on how that's going to work. Similarly, the hourly and salary pay reduction, the 25% reduction rule, it's a very similar calculation. If at any time during your covered period you drop below your normal levels, as long as you return to normal by December 31st, there will not be a reduction based on those rules. Now that was kind of clarified a little bit in the application that came out, but the Flexibility Act kind of expanded on that a little bit. So if a borrower is unable to rehire or replace a terminated employee, then as long as certain documentation standards have been met, the forgiveness calculation will be calculated without those reductions factored in. So basically, if you have a documented offer letter to an employee and you've tried to hire them back and they just haven't come back, that's an acceptable attempt to rehire somebody or replace a terminated employee, and that will not have a negative impact on your forgiveness amounts. Additionally, if a borrower can document that from March 1st through December 31st, that it was unable to return to pre-COVID-19 workforce levels as a direct result of safety, sanitation, or social distancing guidelines, as long as you can document that, then your forgiveness calculation also will not be reduced as a result of not hitting those levels as you were prior. So they're not going to negatively impact your loan forgiveness simply because you could not return to those levels. So in terms of documentation, an offer letter is probably going to be your best bet. Emails are another thing. Text messages are, if you have absolutely nothing in text messages, it's probably going to be, it's going to help, but it's probably not the best support. So if you can get an offer letter to those employees, that's going to be the most advantageous documentation for your efforts. So these next few slides, I'm going to go through kind of in detail with some examples of the tests and how it's going to work out. So starting off here with the FTE reduction test, as we said, there's two different options and there's two different base periods that you can test along with your covered period. So we have 7 employees here, all with varying hours worked at varying times. So the first 2 windows there, we've got the base period from February 15th, 2019 to June 30th, 2019, working 34 hours. So a 34-hour under the first option equates to a 0.85 FTE count. Under the second option, since they're less than 40 hours, that's going to equate to a 0.5. So we do that for each one of these employees based on their average hours worked during each of these windows. One thing to note is, the third employee down there is 42 hours. You cannot exceed a 1.0 FTE equivalent. So anybody that works an average greater than 40 hours, they're still capped at a 1.0. So they're not going to be able to benefit anything additional to that. So we go through each of these periods. We go through the February 15, 2019 to June 30, 2019, calculate our average FTEs during that period. Then we can also look at the second base period between January 1st, 2020 and February 29th, 2020. And then we can kind of compare those two. Now, the way that the act is written, or that it's read, the ratio is going to take that's going to be your base. So between the two base periods, that's going to be your denominator. So your numerator is going to be your actual hours worked during the covered period. So you take your average during the covered period, you do the same test, you take your, between option 1 and option 2, you take your per hour test and your either 1 or 0.5 test, and you calculate that. So at the top of that little diagram there, you can see we've got a summary of each one of those. So for February 15th, 2019 to June 30th, 2019, the average FTE is either 5.7 or 5.0. Your goal should be to take the lowest one possible there. So you're going to take a 5.0. Doing the same thing with the January 1st through February 29th, 2020, you have 5.85 and 5.50 average. So you're going to take a 5.50. And again, during the covered period, you have a 4.83 and a 4.50. Now, contrary here, we want to take the highest number. That's going to get you the most bang for your buck when it comes to the FTE reduction test. So we're going to take the 4.83. So between both base periods and the covered period, the numbers we're going to want to select are the highest one for the covered period and the lowest one for the base period. So we take the 4.83 from our covered period and our 5.0 from our base period, take a ratio there. That gets us to 96.50%. So what that ultimately means is that whatever your allowable and forgivable expenses come up to, keep in mind this is after doing the 25% payroll reduction test. So after you reduce for the 25% payroll reduction, then you multiply it by this ratio here, this 96.50%, and that is going to ultimately come down to a forgivable amount for your loan. One thing to keep in mind is that bottom percent there, the percent FTE employees retained at December 31st, 2020, that cannot exceed 100%. So if you have a number greater than 100%, if you have a higher FTE count during your covered period than your base periods, you're still capped at 100%. The next test that we're going to do, that we look at here, is just making sure that we're not exceeding the $100,000 annualized compensation per employee. So what we've done here, this example is based on the 8-week period, and as Sam talked about, your cash up front and accrual on the back. We're just assuming that you just have a straight 8-week period here. So we didn't factor in any additional time for cash payments up front and accrued days on the back. So this is just a straight 8-week period. You can do this with a 24-week period, and yes, you can still do it with the cash payments and accruals on the back end, but you're still limited on a per employee basis to a certain amount. So for the 8-week period, the amount that you're limited to per employee is going to be $15,384, which is basically $100,000 annualized divided by 52 weeks of the year times 8 weeks during your period. That's how they come up with that calculation. Likewise, for the 24-week period, you're capped out at $46,154 per employee. So if you paid an employee greater than $15,384 during the 8-week period, then you have to reduce the eligible expenses by that amount. Now that doesn't hinder you on forgiveness. You're just not allowed to include that expense as part of your costs incurred for forgiveness calculation purposes. So it's not a direct reduction to the loan. It's just those expenses are not allowable ultimately. So in this example that we have here, the first two employees there, we've got a $14,000 total and $12,000 total. Again, both under the 8-week period, so they're both under the 8-week amount of $15,384. So you're not going to have any issues of having to reduce their salary. The third one there, however, though, Sorry, I realize we're a little bit behind on the slides there, so catching up. But the first two employees there, like I said, the 14,000 total and 12,000 total, they are within their 15,384 limit. The third employee there and the fourth employee are both over the 15,384 limit, so we have to exclude their costs that are over that amount. So the first one is over by $1,400, and the second one there is over by $3,115. So cumulative amount between these 6 employees, $4,531. So that's the amount that we're not allowed to include in our forgiveness calculation. They're just not allowable expenses. We'll be sending these slides out, so if you want to download them, you can kind of catch up on some of these. Again, it's fairly straightforward in what's allowed and what's allowable for the compensation, but fairly straightforward on the calculation. Again, you can do the same thing for a 24-week period, and that again, you can't pay somebody more than $46,184. One thing to mention though is on owner compensation. An owner is not permitted to give themselves a raise if they just to get it forgiven. So an owner's compensation is going to be limited to the lesser of 2019 compensation or $100,000. So if you're an owner that made more than 100,000 in 2019, this doesn't necessarily apply. But if you made less than 100,000 in 2019, that's going to be your new baseline for what you're allowed to include as a forgivable expense, and you cannot give yourself a raise just to get it forgiven. Next is the 25% payroll reduction test. Again, you have 2 different types of employees to determine here whether they're hourly or salary. The 25% test, again, you can reduce somebody's pay up to 25% without any negative ramifications. However, as soon as you go above a 25% payroll reduction, that's when it's going to negatively impact you. So looking at our examples here, if you have for the first employee there, if you don't reduce their pay, there's nothing to do. That's the test. But that second line down, if you reduce their pay, then we have to look into a little bit further detail. So we're going to say during the average salary, and this is tested based on the first quarter of 2020. So if their average hourly pay is $12 an hour, and then during the covered period you reduce them down to $7 an hour, that's a 42% payroll reduction. However, the first 25% is allowed, so that 17% excess is what's going to be factored into your forgiveness reduction. So taking that from there, you take their average number of weeks or hours per week at 32, multiply it by the number of weeks during your period. That gets you the forgiveness reduction for an hourly employee of $512. Now, likewise, that third employee, if we say that their base pay is $10 an hour and we drop them down to $8 an hour during the covered period, that's only 20% reduction. So even if they work an average of 32 hours a week, there's going to be no forgiveness reduction as a result of that decrease, because we're only at a 20% reduction. So that doesn't negatively impact you. Similarly on the salary side, again, if you don't reduce anybody's pay, there's no test there. That's the answer. But if you do reduce somebody's pay, it's a very similar test. You take their average annual salary from first quarter 2020, and we're going to say this first example is 60,000. Then you take their average annual salary during the covered period. If we say that drops down to 40,000, that's a 33% reduction, which is an excess of 8%. So when you go through the calculations to kind of determine that results in a $769 reduction to your forgiveness amount based on an 8-week period. Similarly, if you have only the next employee down, if you only have a 9% reduction, that's allowed. You're allowed to reduce somebody's pay without any negative ramifications up to the 25%. Now, the question has been asked before, what if I pay somebody an annual salary of $100,000 for a normal 5-day work week, but then I reduce their salary down to $60,000 but by only make them work a 3-day work week? Is that really a reduction in salary? Now, our interpretation is no, it's not a reduction in salary, so you're not going to get a negative impact there. But where that is going to hurt you is on your FTE count. That's going to have a reduction in FTEs, which will have a negative impact overall. So keep in mind, just because you reduce somebody's salary isn't necessarily the only thing that you have to look at. You have to look at the hours that they reduced as well and kind of compare that. So when it comes to calculating forgiveness, there are 3 numbers that we kind of look at overall. So the first thing we look at is our modified total costs based on having our 60/40 payroll after we reduce it for the 25% payroll reduction, and then we reduce it again for the FTE reduction. That comes up to a modified adjusted expense total. Secondly, we have our full PPP loan amount. That's just going to be, that's the maximum that you could get forgiven, is the entire amount. And thirdly, it's based on payroll costs. So you take your eligible payroll costs, divide that by 60%, that becomes your new revised amount. So the loan forgiveness, you compare all 3 of these amounts, the loan forgiveness is going to be the smallest of these 3 calculated amounts. So this slide here kind of goes through an example. One of the things that you don't see on here is I assumed for ease of use here, I assumed a $1 million loan for initially. So we have $1 million that we can use for these calculations. The first thing you see there is total eligible payroll costs of $481,969. Now the previous examples that we have here all tie together into this. The total salary that I used was actually $486,500. However, if you remember, we had some salary that averaged over $100,000 with annual salary that does not count. So that's just automatically reduced off the top. So that gets us back down to our total eligible payroll costs of $481,969. For the non-payroll costs, I just assumed a rounded $348,000. That's going to be a combination of mortgage interest, rent, equipment lease payments, utilities, things like that. So that's all combined together in that $348,000 amount. So the first thing that we do here is we have to look and say, hey, is that a good ratio? Now the first thing we see there is the percentage of funds used is actually 58% payroll and 42% non-payroll, which is below the required ratio of the 2. So we have to adjust that. We have to take off some of those non-payroll costs. Now, as I said at the beginning, payroll is the driver. So we're going to stick to our $481,969 payroll costs, and we're just going to adjust our non-payroll costs accordingly. So we have to get that ratio back to a 60/40 ratio. That's going to require reducing our non-payroll costs by $26,700 almost. So we take our total $829,969 that we initially planned, and we reduce our amount by that $26,687 to get to a revised eligible expenses of $803,282. That becomes our new baseline for that. From there, we then take a look at the 25% payroll reduction. Now, again, these are the same payroll reductions that we looked at earlier, where you look at the salary reduction and the hourly reduction. That's the first step that you have to look at. We had $1,281 of salary and pay rate reductions for this 8-week period. So we have to take that off of our forgivable amount. That automatically comes off. Takes us to 802,000 allowed or eligible. From there, we can finally apply the FTE count. Now, if you remember back from an earlier slide, we had 96.5% of our FTE count during our cover period or as of 12/31 compared to our base period. So we have to take our 802,000, multiply that by 96.50%, and that gives us our modified total. That's the first number from the previous slide that we look at as our modified total. So that gets us down to 773,930. From there, you compare, you can kind of determine what your forgiveness amount is going to be. So you compare that to the full PPP amount of 1 million. So obviously the 773 is less than the 1 million. So we know that we're automatically have to give some money back. But then we can also compare to our eligible payroll costs, the 60-40 split. So that 60-40 split, remember, that's at the beginning, the 803,282 based on the 481,969 of payroll costs. So that's 803,000. So we compare the 803,000, the 773 modified total, and the 1 million of PPP funds. We take the lowest amount, and that becomes our forgivable amount. So of the three, it's going to be our modified total of 773,930. The remainder is the amount that's not forgiven. That's the 226,069. Now, that 226,069, that's what becomes a loan payable back at a 1% interest rate. The term is where it's going to be, you have to kind of know when you got your loan. Loans that were obtained as part of the Flexibility Act after June 5th were converted to a 5-year period. However, loans prior to June 5th were still on the 2-year period. There's still some more guidance to be coming out on this, on how that's going to be calculated, because I know some of the loans can go up to a 10-year period, but we're still awaiting more guidance from the SBA on how that's going to be, how that's going to appear. So that's kind of the forgiveness calculation, a big example. What we have done, we've created a forgiveness calculator tool, which is what you've kind of seen here recently. That's straight out of our tool that we can help with calculating forgiveness on something like that. But in order to be forgiven, there's certain documentation. You have to keep certain documents in order to qualify for this forgiveness. So payroll reports during your covered period, verification of existing debt or lease obligations in place prior to February 15th. So if you sign a new long-term debt deal after February 15th, unfortunately, that's not an allowable expense. So that will not be forgiven. So your debt had to be in place before February 15th. Again, statements showing business mortgage, interest payments, utility payments, things like that. If you have statements to help support your eligible payroll expenses and non-payroll expenses, that's what they're going to be looking for. And as Sam mentioned, for loans over 2 million, it's going to require certification that you run a needs-based lending. So there are things that you have to attest to when you fill out the application that's going to get that. Page 10 of the current application has a lot of the documentation required and the timing that you're going to be required to keep all these documents. There's a chance you could be audited. As long as you keep all this documentation, that's going to be your best support. And it's the timing suggested is 6 years. 6 years on that is how long you should keep all this backup support for that. So again, that's on page 10 of the current loan application. And speaking of the application, we haven't seen it yet, but there's supposed to be a revised forgiveness application coming out. Don't know what that looks like as of today, but keep an eye out for something like that to come down the pipeline, and we'll kind of see what that looks like.
Yeah. Well, thanks, Brian. That's a lot of good information on the calculation. As you can see, there's a lot of interest rate calculations related to the forgiveness. We wanted to spend a lot of time on the forgiveness calculation itself, and there's a lot of rules that's around the PPP and timelines and things, but we really wanted to focus in on this webinar on the calculation itself. Another good practice, Brian mentioned a few, is when a lot of people got the loans, we recommended having it isolated to a separate account. We still recommend that. Tracking things in a spreadsheet and keeping the documentation, like Brian said, those are going to be critical things, as you may have to, you know, if you do get audited or questioned in subsequent years on this. Also, the over $2 million loans that would have to, if you have to justify the needs basis based on that FAQ 46, you really want to make sure you do some analysis of it and look at your economic conditions. Did you operate in a shelter and stay? Did you have headcount reductions to prevent headcount reductions? Look at working capital needs, loan covenants. Those are things to be thinking about as you put a narrative together and some analysis together around your needs basis. So hopefully it doesn't get called into question, but if it does, you're prepared. So with that, I do want to wrap things up. I want to thank everyone for being on the webinar today. A little housekeeping, due to overall the amount of people registered for the webinar, we're going to have we have an email address up on the slide that you can email questions to. We'll get back to you with answers. But again, thanks for everyone for joining the webinar today. Hope it was informational, and definitely reach out if you have any questions.